Well, howdy there, folks. A 3-for-1 here tonight on the Reaction channel. Got 3 videos to react to. First one up here is in regards to Elon Musk. I just want to watch this little section of Maverick of Wall Street's video here today, discussing what's going on with Elon. And things have gotten so serious there that they've gotten to, let's call it, the highest level of serious now. It's insane what's going on with Elon Musk in this whole situations. I will say that, okay? Then I want to go ahead and react to this video. The Fed cannot step in to provide stimulus at this time. I want to react to that one there. And last reaction we'll do here today is post-midterm sell-off is a solid buying opportunity, says an $8 billion money manager. So we'll hear what their points are and react to that one. Hope you guys enjoy this as always. Thank you so much, everybody that subscribed to the channel. 19,000 plus subscribers at this point in time. I appreciate each and every one of you that are enjoying the reaction channel, and I try to always find you guys some good clips out there. Maverick of Wall Street, really like his channel, really like it. I watch, I mean, he's probably the only, actually he is the only YouTuber that I would say I probably watch every single video of, to be honest. I really enjoy his channel. A little, he's a little more on the bearish side, a little more on the pessimistic side, I will say that, but he's not like an obnoxious bear. Like some people are like that obnoxious side that they're like so full go bear mode all the time that they're kind of annoying. He's not like that, and I appreciate his channel. So yeah, hope you guys enjoy this. I always appreciate you being here.
Elon is in a world of trouble right now. He got himself into something he cannot get out of easily. And I said before, this will be the beginning of the end of Elon Musk. Number one, by acquiring Twitter, he alienated a group of very powerful...
And I can assure you, he did say that. He predicted this, actually.
The group that runs the country. They don't want Twitter to be a free speech platform. That goes against their agenda. They're going to punish Elon. They're going to make him feel the pain. That's number one. Number two, Elon is out of his mind right now. He completely lost it. For one thing, Twitter remains a non-free speech platform. The censors are still here. But most importantly, see, a market commentator like me has to be careful not to alienate Republicans or Democrats. I try to be as neutral as I can without being boring, so I have an opinion, and I'm going to say my opinion. But again, I'm a market commentator doing a show from my garage. I'm not running a multi-billion-dollar business like Tesla, which, by the way, the consumers of that company happen to be Democrats, liberals in the coasts. The people who buy Teslas happen to be majority Democrats. But this guy goes on Twitter and alienates his core consumers. A lot of folks now say I want to buy an EV, but I'm not going to buy it from Elon Musk. The rise of Tesla was due to the brand of Elon Musk, an innovator, a smart guy, the Edison for a generation. Now this brand has been tarnished, and it's going to tarnish Tesla's brand. And if that was not enough, Twitter is now bleeding money, millions and millions and millions of dollars every single day because the advertisers are out. And Elon has to bankroll the company. He has to pay the employees. He has to pay the bills. And his piggy bank, the ATM, is Tesla stock. And what?
Yeah, if you don't know this, and I think this is very important, if you haven't seen, there's been a bunch of major advertisers, not small companies, major advertisers that have pulled their budgets completely out of Twitter to look more into what's going on there with Twitter. So this is a dramatic situation, and if I had to guess, you know, Twitter is going to be, at least in the short term, in a very tough financial situation. Obviously, they just had mass layoffs, but that's actually a costly maneuver. And if you look at Twitter's actual like net income over time, I mean, it's mostly net losses and some pretty darn substantial ones. Once again, he did just cut a ton of employees, but that's an expense in itself. That is usually a one-time massive hit to a company. And even if you look at their latest quarter, they'd posted a loss of 8 cents a share, and that's on an adjusted basis. So do keep that in mind. And so if you're going to keep funding this company, it's going to have to be out of Twitter's old piggy bank, the balance sheet, and some cash there, or it's going to have to obviously be out of Elon's pocket personally, which, you know, as Maverick points out here, his main like instrument, if he's going to sell something, is not SpaceX or something else. It's Tesla stock.
And he's done with dumping Tesla shares. He's now dumping more. In an SEC filing today, Musk declared he sold around 19.5 million shares over the course of 3 days in November, worth around $3.95 billion. Tesla shares are down nearly 49% year to date. Wow. It's going to get worse with Tesla stock as he continues to dump. Somebody got to bankroll the company if it's not generating revenue. And when will the bleeding stop? To begin with, Twitter is...
Tesla's down 55% year to date. This Yahoo must have been from yesterday's numbers.
Right now, we don't have free speech. But on top of that, he keeps experimenting. He got a gray official label in the morning. By the afternoon, he took that off. And Elon says, please note that Twitter will do a lot of dumb things in coming months. We will keep what works and change what doesn't. Meaning, in the upcoming months, he's not going to have any ad revenue. Which company wants to advertise in an experimental platform? Nobody. In other words, he's going to keep dumping billions of dollars worth of Tesla shares. And I say thanks for the heads up to double down on Tesla shorts. It's in the bag now.
And by the way, most companies are actually pulling back on advertising spend right now. So, you know, you don't want to give them any reason to pull back on ad spend right now. Let's just put it that way, because they're very happy to be like, oh, I have a reason not to spend on this platform anymore.
Experimenting is done. Elon Musk managed to alienate all of these advertisers. He says the content is actually improving. It's not getting worse. I don't see a difference right now. And earlier today, Reverend Elon came out and said to the car manufacturers, rest assured, Twitter is not going to be a biased platform for Tesla. He's not going to use the platform to pump Tesla at the expense of GM, Ford, or whatever manufacturer it is. Now, car manufacturers happen to be one of the biggest spenders on ads, be it on YouTube, Facebook, Twitter, doesn't matter. So now Elon is begging GM, please don't stop the ads. What a turn of fortunes. Sam Bankman-Fried is homeless right now. Elon Musk is begging GM, the dinosaur he used to make fun of. Wait till you hear the next story about Mark Zucchini-Bird. We'll talk about that in a minute. But when it rains, it pours for Elon Musk. Today, the president of the United States, Joe Biden, came out and said that Elon Musk ties to other countries should be looked at over national security concerns.
What a stupid son of a bitch.
He says Elon Musk is a
It's just in case anybody doesn't know, that particular clip was not what Biden said in relation to Elon Musk today, just so you guys know. But Biden did say this. He said, he needs to be looked at over national security concerns, which is a huge statement when it's coming from the president of the United States, that's for sure.
Security concern. A South African immigrant. And specifically, he says that his ties to Saudi Arabia is the problem here. And in defense of Elon, I say, if Elon Musk is indeed a national security threat, then I think our entire intelligence structure must be investigated and reprimanded. They allowed the national security threat to fly our spy satellites to space for years. And nobody said anything about it. Nobody said that Elon Musk is a national security threat. But now that he's taking over their public manipulation tool, the propaganda machine, all of a sudden Elon Musk is a national security threat. And speaking of egotistic asshole billionaires...
Whoa, don't try to get me demonetized here, Maverick. Holy smokers, this ain't no jokers, okay? So anyways, I enjoyed that clip there, and there's no doubt Elon has... there's a whole different situation now. I mean, the SEC thing years ago was that whole situation, right? It was what it was, but Elon now at this point in time with this Twitter fiasco and the trying to turn around that platform that's been a broken platform for a long time, that is set up certain ways because of certain things, and now he's trying to change it all. And it's like, you could have just literally started a new platform and spent way less money and probably created a platform people would actually enjoy and like and maybe even love a lot more, and probably even gotten a profitability faster. You never really know, right? And instead he's taken over this thing, and it's causing a lot of outrage, obviously. And now you got the president of the United States talking about him as a potential national security threat. I mean, it's intense. That's all I'll say about that whole situation. Okay. Next up here, the Fed. Let's go ahead and react to this one. Give my opinion on this here.
In agreement with the camp that is saying we may have seen some gains in recent days, but don't get fooled into thinking that we're through the crisis at this point.
So I think we have overcome interest rate risk and inflation risk. Mm-hmm. We've fully incorporated that. I think we are starting to understand credit risk, recession, etc. What we haven't got our arms around as a market is market functioning risk, liquidity risk. And that's the one thing I'd keep my eye on. I think that still has to play out as the Fed continues to march up with its interest rates.
But you don't think it should slow the Fed's role in terms of...
I will say this. He just mentioned about liquidity risk, right? And what I have seen in the stock market is definitely some liquidity risk in countless stocks. How do I know this? Well, I know this because if you look at what a share's trading at for their volume in a particular day, and you look against their average volume, what I see continually is countless stocks outside of like a few big, huge names that are on some crazy volatility day or something like that. Countless names trading massively under their average volume. And because of that, we obviously know there's an overwhelming, if there were, say, selling pressure or buying pressure on the market, what is there? There's more selling pressure than buying pressure on the market in 2022. We all know that, right? But when you don't have much liquidity on the other side, it's going to keep dumping the price more and more and more because it's just not a large amount of buyers on the other side. And it seems like there's always a larger amount of sellers out there because of liquidity problems, right? So let's say you got 100 people that want to sell a stock in a particular day, and you've only got 20 people that want to buy. Well, shoot, what's going to happen with the price? It's going to go down and down and down. That's the way the market works, right? And the sellers are going to get more and more desperate, and so ask for a lower price, and the buyers are, in a pretty greedy position because they're like, I don't need to buy at this price. It's going lower. I'll buy in 10 minutes from now, an hour from now, a day from now, a week from now, a month from now, and it's going to be lower. So I've definitely noticed some liquidity issues in the market in a major way. And I think eventually it's going to end, but I don't think it ends really right now. The liquidity problems, I think, will end whenever the Fed switches, which, I mean, with how fast things are deteriorating, I'm seeing out there, it's probably going to be sooner rather than later. Not this year, obviously. But yeah, I mean, things are, you see what's going on out there. It's happening pretty quick now at this point in time.
They're doing with higher interest rates.
Look, I'd rather the Fed not be late. I'd rather the Fed not having to increase rates so quickly. But given that it's so late, I don't think they have a choice. I think the alternative of not reacting will be worse for the economy and will be worse for the markets long term.
We have talked about how the consumer has been really very healthy, how they've had been flush with cash. They still have the jobs market's very strong. Wages are up, even if they're not as up as much as inflation. But you were tweeting about a few things last night, just some concerning trends that you're starting to see with consumers in terms of what they're doing with credit cards.
Yes,
I would love to hear what he has to say as far as that goes. How I would answer that is I would say, yeah, consumers are in a great spot as long as they have jobs. But what about the 11,000 employees that were just let go from Meta? What about all these Silicon Valley companies that are mass letting go employees right now? How is their situation, right? Their situation just got extremely bad, extremely fast. And those folks are now going to the unemployment system, which many times on an unemployment system, especially if you have a good paying job, it's not paying what the old thing paid, right? And then it's like, okay, can they get a job after the unemployment benefits potentially start running out? Or what's that situation like, right? And so that's definitely a major factor that is like, as long as people always have jobs, you can do okay in the economy. But as soon as jobs start being cut in a major way, that's when you start running into real problems real fast.
Even credit is now at a record high. It's gone up by 9% in the last year, keeping up with inflation, but it's still at a record.
What went up 9%?
Keeping up with inflation.
Missed that.
Yeah, so revolving credit is now at a record high. It's gone up by 9% in the last year, keeping up with inflation, but it's still at a record high. And what we're seeing is a segmentation of the consumer base. So while consumers in general have a strong balance sheet, while the labor market in general is strong, once you look at the composition, so if you are selling to the lower income segments of the population, you're seeing significant declines in sale.
Yep.
And that's what's happening, is we're seeing a segmented household sector emerging.
Two things about that. First off, this is very important for everybody to understand out there. Who does inflation hit the most? It hits, obviously, the folks that make up less than $50,000 a year. It hits those folks the hardest every single time. Because, even what seems like small price changes, like a gallon of milk going up 50 cents or going up $1 or this or that, right? All those things affect you more if you make less money. If you make $500,000 a year, the price of bread being 10 cents extra, 20 cents extra doesn't really hit you. But the lower your income is, it really hits you hard. So I think that's a very important thing. Now, the second thing is he mentioned there about revolving credit being at an all-time high, up 9%. Well, that should always be at a record high. It should always be going higher year over year over year, right? You don't want to see like an insane amount. And obviously with inflation being 7 and 9% this year, revolving credit being up about the same is about what you should expect. There should be no real scenario outside of a freak situation where the government maybe pumped a ton of money out there, like, what obviously would happen in Rona, where revolving credit necessarily goes down. Like, it's natural that it goes up over time, right? So I just think that's important. Like credit card debt, auto loan debt, home debt, everything over time should go up. It'd be great if it went down. Well, it actually wouldn't be great because it would be devastating to the economy. But yeah, it's just not how the real world works, to be honest, unless there's a major contraction in confidence and spending.
I mean, that's bad news for the people who are most potentially in peril. Will there be any move that comes from politics? Like, let's say when you're looking at this, if the Republicans take the House, as is anticipated at this point, not sure what's going to happen with the Senate, but what moves, if any, would Washington make to try and help those at the lowest rungs? And
you all called it evenly divided, closely divided.
That was my mistake. Yeah.
There's two views on this. There's the one view that because they're so evenly divided, they'll come together. I don't believe that. There's the other view that because they're so evenly divided, everybody will focus on the election in 2 years' time, and they won't come together. Now, the conventional wisdom is that gridlock is good for markets. But we have to understand that it depends what path you think the economy is on. In 2010, the economy was on a similar path to today, meaning that without stimulus, it was going down, but the Fed could step in and provide stimulus. This time around, the Fed cannot step in and provide stimulus. So I don't think it is good news that we're not going to get anything out of Congress for the next 2 years. I think we need to focus on a new growth model. We need to take the supply side much more seriously. And I do think there's a problem that the emphasis will immediately shift to the election in 2 years' time, and very little will get done.
You know, I thought something was interesting actually in that Mav video earlier from tonight. He brought up a great point, and he was talking about how, you know, Republicans are so disappointed because the massive red wave didn't happen, right? And I thought he brought up an ingenious point, and I was like, 100% I agree with this. He said, if anything, Republicans should be happy. They're potentially not going to have the House and the Senate. And he said the reason is because, you know, the economy is falling off the rails. Do you really want to have the party that has the House and the Senate be blamed for that? I thought about that and I was like, it's brilliant. It's absolutely brilliant, because why would you? You're going to be the one that's blamed, because then they're going to look at it and they're going to say, oh, see, Republicans got the House and Senate. This is why the economy's fallen off the rails. Before they had the House and Senate, look at the unemployment rate. Because let's imagine the unemployment rate is going to go up several percent over the next year. It might not happen, but let's just say it happens, right? Then all of a sudden, if Republicans have the House and Senate, then they're going to take the blame for that, right? So I actually thought that was a very interesting comment that I absolutely loved. And so, you know, if you're a Republican out there and you're really sad about the whole red wave thing, you know, not really playing out, you know, it might be a blessing in disguise in that whole situation, okay? Next one up here, post-midterm sell-off is a solid buying opportunity, says $8 billion money manager.
Focus on tomorrow's CPI report for October. Economists expect prices rose 0.6% from the previous month, an increase from September's rate as oil and gas prices ticked higher. Markets heading into the report on a down note, with major indices posting their first loss in 4 sessions. The Nasdaq shedding nearly 2.5%. And take a look at Disney dropping more than 13%. That's its biggest decline since 2001. It lost $34 billion in market cap in just one day after yesterday's.
It's crazy how many times I've heard like these insane statistics over like just in 2022. Just in 2022, the amount of stocks I've heard, like, they fell the most since 2008, 2001, or, 2005, or, like, whatever year. And it's just crazy. Even, I think it was either FedEx earlier this year or something. They had their biggest fall since the 90s or the 80s or something like that. And it's just like, you hear these crazy statistics, and it's like, wow. But yeah, 13% for Disney, ridiculous. And that stock did join the down 50% club here today. It did. I talked about that on the main channel earlier in the video I posted there.
Report. Our next guest expects the U.S. economy to avoid serious recession despite historically high inflation. Katrina Dudley is a portfolio manager and investment strategist at Franklin Mutual Advisors. She's got an $8 billion under management. Katrina, great to have you with us.
Thank you for having me.
So what stuck out at me in your notes?
But does she have one of these? No way, baby. No 7-figure award. Oh, man, I can't wait till the days we send out 6- and 7-figure awards again to the private group members. There's been like hardly any we've shipped this year. It makes me sad, man. My garage just collects dust of these 6- and 7-figure awards. 2023, 2024, it might happen again, man. But it's not been, 2022 has not been that year.
We're going to talk about, the macro and all that, is that you like housing. And this is a totally out of consensus kind of trade. And I'm wondering if this sort of is just an outlier trade, just a sort of like a, independent trade, or if this is tied to what your macro view is.
Look, I think if you take a look at the macro environment, it's so easy to be negative on the housing stocks in particular. And we are talking about the housing stocks. In this sense, we've got a market that's completely undersupplied. We haven't been building as many homes as we need. Yes, we know what's happening with mortgage rates. Mortgages are making homes less affordable, but the cure to affordability is really simple. People will buy smaller homes with smaller footprints. We've seen that happen time and time again.
So if mortgage rates, do you think that mortgage rates will go higher? I mean, I'm wondering what's embedded in this bull thesis.
What? What? No. 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 What she said is 100% wrong on a practical basis. She might be looking at a number and it's telling her ... or some algorithm or whatever. No, we do not need more housing anytime soon in the United States of America. All I watch is homes going up everywhere, whether I'm in Vegas, whether I'm in Arizona, ridiculous amounts. All I see when I drive around is massive apartment communities being built, massive condo communities being built, okay? It's the same thing we saw play out in 06 into 07. And when the economy is in some major expansion mode and there's cheap debt out there, people buy a ton of homes. You have people that maybe wouldn't usually buy a home, but they're making so much money that they move out of their parents' home maybe, or they I don't know, they were rooming up with somebody, they had a roommate, they moved out. You have a million different scenarios. You have people buying homes for Airbnbs because that was the thing to make easy money with for a while there. People buying homes for rentals because you could get cheap mortgage rates. So it gave this, we've had this complete fake like housing demand for the past couple of years because of insanely cheap money. And I can tell you, there's not the demand for homes that people assume there is anymore at this point in time. And you're going to really start to see this in 2023 play out in the numbers. And you'll probably see it even more in 2024. And we have this fake pent-up demand for housing based upon insanely cheap interest rates, because people looked at it and it's like, you get a mortgage for 2%, 3%, why not buy an extra home or another extra home? And home prices are just going up and up and up. So, I mean, you're just going to get a great appreciation on that as well. So let's just buy another home, right? And you had all these companies buying homes. Oh my gosh, the amount of companies buying homes, right? And don't be surprised if some of those go belly up over the time here. We'll see. That might be the more of a 2023 story, right? And so you had this fake demand. It's fake demand. And these folks, they don't have street smarts. I think that's what the problem is with a lot of these individuals. They don't have street smarts. And they can't see, like, what was really going on, man. It's frustrating. It's frustrating. They're going to see it. They're going to see it. That's all I'll say about that. They will see it.
Yours. Can mortgage rates go higher, or do you think that we're sort of capped here in terms of the 10-year yield?
I think that they will go slightly higher. If we have a look at what we're expecting from the Fed going into the end of the year and early next year, we still think that there are some rate rises coming. I think the pace of those will slow.
I'm not done. So, she's talking about home builders being the play, right? So first off, home builders are going to have 1 to 2 more quarters, almost guaranteed, of really strong earnings. Almost guaranteed. But after that, I think that we're gonna see some real problems start to emerge because of demand for new homes, okay? And when it comes to these stocks, and I pointed this out in a video on the main channel the other day, and I know all these home builders, but I know Toll Brothers is the best of them. And it's actually a stock I owned back in the day. But the issue is, a company like Toll Brothers, you look at it and it's like, oh my gosh, it's at a 5 PE. It's so darn cheap is what they'll say, right? But here's the issue. A company like Toll Brothers could easily be losing money by the end of 2023 or going into 2024. So you have this company that's making so much money right now because of the crazy demand that I think, in my personal opinion, and I think we're already starting to see it in the numbers, and I think we're going to really see it in 2023, the demand is going to dry up to bone dry. And then Toll Brothers earnings are going to start going boom, 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 boom. And the thing is, with the home builders, when it starts to deteriorate, it goes fast. And when they start taking losses, they're big losses. We're talking $50 million in a quarter, $100 million in a quarter. And for home builders, that's crazy money. If that's some massive tech company, it's nothing. But for home builders, that's big money. And so all of a sudden, you might have a home builder that was making, let's say, $300 million a quarter in profit, in net income. All of a sudden, losing $100 million? How do you value that stock now? So then how you actually value that stock, if anybody's actually interested, is essentially you're going to look at what like the last 10 years of that company's net income is for a company like a home builder, and then try to say, okay, this is the average net income for the past 10 years for the stock. So if I slapped a 10 PE on it, it should be roughly at this price. And so maybe at Toll Brothers, you could figure out it should be at $25 or $20 or $15 or $30 or something like that. Okay. So that's how you do it in valuation there. Little gem for the people that still watch my videos at the nearly 25-minute mark. Shout out, leave me a comment. Just say 25 mins, okay? 25 mins. That's all I need to know. And I'll know you're still here with me, You never know what you're going to get late in the videos.
But if we do continue to have those rate rises, we will see mortgage rates go higher, but they won't go higher at the same clip or the same pace that we've seen them go high over the last year and a half. So I think that we're lessening the pace and lessening the burden of those higher mortgage rates.
Hey, Katrina, it's Tim. Thanks for joining us. Something else that jumped out from your notes was...
It doesn't matter if it's still going higher and you're already at ridiculously high rates. Like, everybody's gotten used to, for the last decade plus, of 2 to 4% mortgages. When you're talking about 7 or 8%, no. Okay, people just can't even consider that. Never mind if people start losing jobs left and right.
On European investing, especially because of the currency tailwind. And I often, as someone that's been in emerging markets, I say FX sometimes is half your return profile. Can you talk about that and also the underlying markets, though? Because we kind of get some of the current account surplus dynamics for the euro, but the underlying stocks still have a lot of headwinds.
Look, if I take a look what's happened in Europe, most people are very surprised that in local market terms or local currency terms, the market's actually done better than the United States. And Europe is really facing a number of headwinds, and they're very clear. It's the Ukraine-Russian war. It is the energy crisis. And also, they're facing the same monetary headwinds that we're facing here. But we think that the market will be able to take advantage of that. We think that they're already priced in. So we actually think it's a really good setup here for European equities going into year end and setting up into next year.
All right, Katrina, we're going to leave it there for today. Thanks so much for joining us. Katrina Dudley of Franklin Mutual Advisors. Julie, where do you stand on any of the trades that Katrina has? And what are you thinking? How are you thinking about CPI tomorrow?
Yeah, I think protecting yourself for CPI and being in a position where you own durable businesses with pricing is pretty important. I think actually her point on housing is really interesting. If you look at where a lot of the home builders are, many of them have really learned their lesson from the last housing downturn. They have a different approach to how they're putting their land banks together, and I think they are smart enough to be able to put together houses that are more affordable. I think they're all looking at their punch lists and sheets and saying, okay, we're not going to do surround sound in the houses anymore. And at the end of the day, there's still such an intense need for.
That was a completely ridiculous point she just made. Like surround sound, I don't know, has she ever built a home before? Like surround sound, something extra you pay for if you build a home. It's not like home builders are like throwing in the surround sound, like, hey, you buy a home, get a surround sound. That's like something you pay for extra, and the home builder doesn't even do it. They outsource it, and they just make a commission on that.
Or housing.
Which, by the way, the home builders make a ton of money off these kind of like affiliate deals because they'll, all these things they contract for your home, right? They'll make a little piece of that pie for a ton of different things.
It's such an intense shortage that I think they probably won't be as bad as they have been in the past. That doesn't necessarily mean that they're investable for the long term, but I do agree. I think that they could be overdone here.
Mm-hmm. Grasso?
Yeah, so D.R. Horton is known to be a spec builder, and it has the best chart in the entire home building complex. I wouldn't run out to buy the home builders because of all the obvious headwinds, but D.R. Horton, if we're concerned about supply, they're the ones that have the supply on the market.
Let me be very clear about this. Let me be very crystal clear about this. I hope the home builders do great the next several years. Because if they do great the next several years, that means we avoided a major recession, unemployment stayed very low, interest rates came down, and the world was grand again, and I made $10 million from stocks. But I don't see that playing out that way. I think the home builders are in for a lot of pain ahead. And the longer interest rates stay high and the longer the Fed keeps interest rates high, the more probable home builders will start taking losses toward the end of 2023, maybe even mid-2023. but toward the end of 2023, and go from, oh my gosh, they're cash flowing so much money, to they're losing money. And obviously, the longer the Fed keeps interest rates high, the more it's going to obviously deteriorate the entire economy, and the more damage you'll see out there, right? And the more quickly that the Fed will start to shift and eventually pivot, right? Which will be good for stocks when that happens. But it will still mean there's likely 1 to 2 years of real estate pain ahead, because when the stock market starts to truly start coming back, real estate doesn't magically start coming back. When you're in a very down cycle for real estate, which is likely what we're about to go into for real estate, and it just started this year, I think 2023 is when you're going to start it's going to start getting really ugly. And for the home builders, they need to pray for two things. One, that the Fed lowers interest rates in a substantial way. The second thing is people don't start losing jobs en masse. If either of those situations play out, the home builders are in for a world of hurt for likely 2 years, maybe even 3 years. I don't know if I want to go that far, but certainly at least 2 years of pain in terms of just the demand's not there for the new builds and things like that, guys. So anyways, appreciate you joining me. Much love as always, and a little positive, a little negative always in there. And 19,000 plus subscribers on this Flippin' Flapjacking channel. You gotta be kidding me. I appreciate all of you for being here. Much love. Check out the videos on the main channel and have a great day.